The Standard & Poor's 500, or S&P 500 for short, is a broad index that measures the performance of U.S. stocks as a whole within the stock market. It contains just over 500 companies or stocks. It may be logical to think within this index, of all the 500 companies, they would have roughly an equal weight and they would roughly perform in line with the average. Is that the case? Let's find out.
The display on your screen has all the individual stocks or companies within the S&P 500, and we have their year-to-date return in descending order from highest to lowest. We can see it looks like 5 of them are over 100%. That's a fantastic return for a little over half a year. As we go down the list, we go to 20, and this one's up 49% for the year, so that's doing great too. Keep in mind the whole index is only up 11.7% for the year. So if we go down, let's see how far we have to go to find that 11.7 number. So we're getting, here's 100. Okay, so 100 stocks are greater than the return so far. Let's see, 150, yep. Keep going down. And here we are. So basically 180 stocks are outperforming the index and the rest. So from 181, we're going to scroll down pretty fast here just to show an example. The rest of them are all negative, right? So we even go to negative 59%. So that shows us here that year to date, a very small amount of stocks is pulling the weight for the whole index. So if every company is weighted equally, how can that occur, right? So if there's roughly 500 stocks, each stock should weigh roughly 1/5%. However, that's not the case. So let's look into what's going on with this. Jump into the weighting behind each stock to really understand how a small amount of stocks are above the return year to date and a large amount are below. So we're going to start at number 1, NVIDIA, and let's look at the weight right here. So we're looking at 7.36%. Well, that is significantly more than 1/5%, which is if they were equally weighted, that's what they would be. And on the right column, we have our cumulative weight. So for example, this 13.67 is just these two numbers added up, and it goes down the list. And it may be surprising to see that if we look at the top 10, they make up 38% of the entire index. That is a large amount. And if we go down to 20 right here, Palantir Technologies, they make up more than half of the return. So 22 stocks make up over half of the return for the entire index. And that is how we understand that a small number of stocks are actually moving the market as a whole. So it does not matter, and I'll quickly scroll down. We can see this weighting here. Keeps dropping. This is 1/4%, and we're at 72. So everything beyond this is less. Look at these as we go down. 1/12%. Here's a 1/10, and we're already at 172 for a 1/10. Let's scroll down to the bottom just to show for emphasis. These stocks are basically meaningless in terms of their performance weighted return for the entire index. So if we scroll back up, this is how we understand that really the movement of top 10, top 20, even top 100, even if we want to cover our bases and get down to about 3/4 of the entire index. These are the stocks that mean the most performance-wise for everybody. These are the ones that we should focus on when we try to say, okay, what is moving the market right now? Because a small amount of stocks are moving the market. And to visually see that in graph form, if we scroll up here, right here's our cumulative weighting chart of the index. We can see this line is just vertical at the beginning, and you're looking at, it says top 11 companies are 40%, and then it kind of slowly starts to even out, and then by the time we get up to 250, we're barely moving the needle.
The bottom line here is that a very small number of stocks has a disproportionate weighting on the overall index return. Focusing on the top 10, 20, even 50 stocks should give us a very good idea of how the market's doing overall. Remember, not all stocks are weighted equally. Thanks for listening. We look forward to seeing you in our next video. Have a great day.